Good evening, everyone, and very warm welcome on behalf of Karma Capital to this portfolio review webinar. And thank you, everyone, for joining in. My name is Praveen Ladia, and the CEO for the business here. As we speak, this is a very special milestone period for us as well as we complete 20 years of our equity investing for our clients. And why we think 20 years is so important is because in the world of asset management, we believe experience counts, and there are very, very few managers in India with such long, unbroken history of money management. At Karma Capital, the investment philosophy is rooted in the belief that successful investing is not about chasing short term trends or market narratives. It's not about chasing short term trends and market narratives. Instead, focus on doing the right things. The process have been refined over years of practice, ensuring we are both effective and adaptable to changing market conditions, which is evident by the fact that we have made money 90% plus of our portfolio companies. Behind our success for these 20 years, it is not just one set of strategies or a single star manager. It is a team that has grown together side by side through every market cycle, every opportunity we have invested into. And this cohesion means that your investment will benefit from the consistent and aligned approach, not just today, not for next month, but and that's how we believe about team approach. With this, let me introduce our team on the call with me. We have Rushabh Seth, who's the co-founder and co-CIO of Karma Capital, has been a pioneer of more than 30 years in equity investing with various organizations. We also have with us Vinay Jain, who manages our all cap strategies, and with us for over 12 years now. As a team, we have also stick around together. We also have with us Ekta Mehta, who manages our small and mid cap strategy. She's also with Karma Capital for over 10 years now. And the three members will be speaking over next 20 to 30 minutes about portfolio updates and market trends. The way we would structure this is that we try to keep it very short and crisp and spend more time on Q&A. We'll start with a broad market update and a brief update on Karma Capital by Rushabh, followed by portfolio updates by Ekta and then Vinay, and then we'll open the floor for Q&A. If in between, if you have any questions, you can type on the Q&A box on top of your chat window, and I'll take it up at the end of the presentation. By us, we'll try to keep it short so that we have more conversational time. Over to you, Rushabh.
Hi, thanks, Praveen, for the introduction. Can you guys hear me? Yeah, perfect. What I will do, I will quickly introduce Karma. I'm sure a lot of people you all know us already, but just for the people who don't know us and are not familiar, next slide, please. Yeah. We started about 20 years ago, as Praveen said. 2025 is a milestone for us in many ways. From our perspective, Karma has been around for 20 years. We've seen a lot during these 20 years, multiple market cycles. We've gone through a lot in terms of, when we started out, PMS as an asset class was very, very small. And you barely saw even money in the private sector mutual fund. From there to where we are today has been a long and a very interesting journey for us. Today, as a team, we are about 30 people spread across the country with about 125 years of investment experience. The two of my colleagues, Vinay and Ekta, are on the call. They've been with us for more than a decade now. We manage close to about 7,500 plus crores. A large part of these assets are from offshore institutions. We are domestic, small, and build that much more aggressively over the last 2 years. And therefore, as I said, now we are starting to be maybe better known as compared to what we were about 3 years ago. Still, there is a lot of grudge from people that we are still not well known. I think the calls that we do on a quarterly basis hopefully kind of gives a greater familiarity for Karma with our investors. We have worked over the last, I would say, 15 years with a lot of offshore institutions, which has given us an institutional mindset and a framework. So though we are a small boutique shop, we think much more like an institution from a process and from a Karma perspective, as I would say. And I think that is very important to what we do. From a to be able to manage money for somebody like Norges, who has been with us for about 13 years. They are one of the largest sovereign funds in the world. And I think that kind of gives you a flavor of the kind of work we do at the back end to be able to retain and build on these clients. And I think from our perspective, the 20-year track record speaks for itself. We have added alpha throughout these 20 years that we have been around. And I think that kind of is very important to what we do. We always with a lot of pride, we say that we've added alpha across market cycles. Next slide, please. So just to kind of make it more contextual and relevant, I will just take you through the current market environment. These are very small presentation, 2 more slides. Then I will hand it over to Ekta. Just to kind of give some context on the current market environment, we had said last time when we met that there was a slowdown in the economy. We think that now with the GST cuts, we're starting to see growth pick up, and growth will pick up in the second half of FY26. We've seen a time correction till about early October. The markets were flat Y to D. Even today, the markets are maybe up about 4-5% YTD. And I think that clearly we think that the sideways correction in the market is allowing the valuations or the earnings to catch up with the valuations, because valuations were running far ahead of the earnings last year. And I think now we are starting to see the catch up happen. Our view, and we had kind of alluded to this last time as well, that the cycle that we've seen post COVID is kind of maturing and maybe coming to an end. And that's quite visible from the fact that some of the cycle leading companies which led the previous cycle, like Trent, ABB, including IT, I've seen significant price corrections. And that's clearly kind of reflects on the changing nature of the market. One of the things which has continued to remain the same in the market is the domestic flows. Though the FIIs have been selling over the last, I would say, year or so more aggressively, it slowed down a little bit in the last couple of months. And that's also visible in the fact that markets have done well in the last couple of months. And the domestic flows are still continuing to be very strong. And of course, because of this change in nature, where FIs are selling and domestics are buying, also has an impact on what does well in the market and what doesn't do well. We had last time mentioned that there was still a lot of ambiguity on tariffs. Thankfully, since then, I think though India has still one of the highest tariffs, but at least clarity is starting to emerge of how the structure of tariffs will look like. Hopefully, we should be able to strike a deal with US pretty soon. And that kind of would ensure that we get to a more normalized tariff as compared to the 50% that we have with US currently. So our hope is that we are able to strike a deal with US soon. And that kind of brings India to a more normalized tariff as vis-a-vis other competitors. Valuations still remain high in pockets of the market, and that's because of the flows that we've seen in the domestic side, as well as the narrative that we see around a lot of these stocks. And this time, the small and mid cap have a disproportionate share of these higher valuations, which is quite ironic because most of the times, though some of these companies are growing faster, they also carry a significantly more risk. So our view of the world, and we've kind of been consistently talking about this for now, I think, a couple of quarters, is that the portfolios will need to be positioned for the next cycle. And I will kind of allude to what we think will the next cycle look like. But for sure, a lot of the stocks which have done well in the last, I would say, 4 or 5 years might not be the ones to bet on from a next cycle perspective. Next slide, please. Yeah, thanks, Pramod. So from our perspective, India has been underperforming for the last, I would say, year or so as compared to both EM and DM, so which is quite unique. So India used to generally perform well when emerging markets used to do well. This time it's been a very interesting phenomena where despite of all the flows in the domestic side, India has underperformed both the EMs and the DMs in the last year or so. And hopefully, maybe we are at the end of that underperformance period from a market standpoint. I think the biggest thing which we are seeing, and this has really captured the imagination of the world, is the disruption which AI is causing already in many ways, or is expected to cause over the next few years. Our view remains that AI is maybe one of the most disruptive technologies we have seen since internet, which was about 25 years ago. So these kind of technologies comes in once in a generation, and we have seen almost a generation after the internet that we are starting to see growth of AI. And we are at very early stages of this cycle. We don't know how and what shape and form it will take. There is a lot of conversation I hear about AI bubble and AI overinvestment. I don't know about that, whether it's a bubble or not. But I must tell you one thing, that we believe it's going to change a lot of industries and a lot of businesses fundamentally over the next 5 to 10 years. So AI is here to stay, whether we like it or not, and it will be disruptive for many businesses for sure. Um, Industries are changing shape. So within industries also, we are starting to see a lot of shift. As you would have seen, FMCG, retail, etc., are getting disrupted, are getting, I would say, fragmented by multiple kinds of newer players, new generation companies, QS, the quick commerce companies, which were non-existent about 5 years ago. And I think that fragmentation stroke disruption will continue or even accelerate in some cases. On the other hand, some of the businesses are consolidating. We've seen consolidation, as we mentioned earlier, in airlines, telecom, etc. Some more industries continue to consolidate pretty rapidly, and I think that's something is very interesting trend. So you have industries which are changing structure and character very rapidly, and this has a bearing as investors how we look at it over the long term. Within even larger sectors like IT and BFSI, our view is that investors' interest will start shifting to newer areas and newer companies. And again, as investors, we need to be kind of aware of where this shift is happening and where maybe the next big growth opportunity and the next big wave, I would say, of innovation will come from. So from our perspective, alpha in the next cycle will come from thinking differently. We have seen a very, very strong market cycle over the last 4 5 years till about end of last year. And we are clearly starting to see consolidation in the markets. And we think this consolidation will continue, but more importantly, the shape and structure of what the next cycle will look like will be very different. I will kind of stop here. I will let Ekta talk about our Lotus strategy. Ekta looks at our small and mid cap strategy, which is also known as Lotus. And we started the strategy about almost 3 years ago. It's done very well. And I will not talk more about it. I will let Ekta maybe talk to you in greater detail. Over to you, Ekta.
Thanks, Rishabh. Hi, good evening, everybody. Thank you for joining us today. So, like Rishabh was mentioning, we started Lotus in Feb of 2023, and it is a small and mid cap focused portfolio where we would be investing at least 70% in the small and mid cap stocks. And the remaining balance, of course, we have the leverage to invest either in large cap or go higher than 70% within the small and mid cap space. What we believe that the overarching philosophy of karma continues to remain, where we will continue to focus on fundamentally strong bottom-up stock selection to build this portfolio. But if you'll see, Pramod, if you can take to the next slide. While we have been focusing on stocks which have, of course, been growing at a faster space, but we are also looking for stocks which have which stable are under leveraged and are generating strong cash flows. So for us, it is not only about, of course, capturing the upside, but also limiting the downside, which becomes very important in a small and mid cap focus fund. So hence you will see in the bottom portfolio stats, debt to equity is significantly lower for the overall portfolio. And these companies are generating cash flows and return ratios much higher than what you would see in the overall benchmark index. So of course, the growth is much higher for these companies on the earnings side, but you would see them generating much better cash flows, which gives us comfort that even during downturns, these companies would be much better off. And especially in a small and mid cap, when the recovery is kind of uneven, you would see companies with strong fundamentals and a strong balance sheet would be able to come out of it much faster. So that's on the portfolio stats. If you look at the allocation, of course, BFSI, as you can see, is a larger allocation at 24%. But the color within our portfolio of BFSI stocks would be very different. So for us, the largest holding within BFSI is a life insurance company. The second largest would be a fintech, which is Paytm. And after that, we also have a regional private sector bank, which is Karur Vysya Bank. So while we would have an exposure of 24% within BFSI, the kind of stocks that we have in our portfolio is very different from the benchmark index or what you would see in any other fund. And of course, you can see the sector allocation among the other holdings within our portfolio. Next slide, please. So what I'll do now is I'll quickly take you through the key highlights of the results of these portfolio companies. So like I was mentioning, one of our top holding is SBI Life Insurance, and it has reported about 10% APE growth in this quarter. But what is also very important is that most of this growth has come from the September month onwards. And in fact, even in October, they have reported a 20% APE growth, much ahead. In fact, it is one of the highest growth within the top life insurance players. And it is doing that despite the GST cut, which led to no input tax credit for all of these life insurance companies, it has been able to maintain its VNB margin year on year, which we have not seen many other companies report. So it is, and of course, SBI Life has always been very good in terms of cost structures. So what we like is, of course, the improving product mix, and with GST going away, we have seen the protection share overall within the industry going up as more people are looking at buying a life insurance because the prices have kind of slightly become lower. And so higher growth, better margins, and of course, the stronger brand name of SBI, and it is available at reasonable valuation. So is what we like about SBI Life. Paytm, moving on to Paytm. So Paytm reported a strong 24% growth in its revenue and EBITDA of about 7%. So you have to look at the EBITDA from how the trajectory and the trend that EBITDA they have been reporting. So from a loss up to last year, they have moved to a 3.5% margin in 1Q to now 7% margin. So the operating leverage that Paytm has been playing out very nicely and as we were expecting that as they grow much stronger and construct and limit the amount of expenses that they do, the profitability will see a significant improvement, which is kind of playing out. And of course, within Paytm, there are a lot of other option values that we see within the business, whether it is wealth, m- uh, uh, secured assets, or even loans against security. So, a lot of other option values we have that within Paytm that can help their growth to be much faster going forward. In terms of Indigo, so they reported kind of inline numbers, and of course they were impacted by the change volatility in the currency movement. But what is important here is to note that Indigo has increased their guidance for the full year in terms of top line growth, but at the same time they have also indicated that the cost could be slightly higher. But overall, we would see the profitability numbers for Indigo to see improvement from this quarter onwards. This quarter, of course, they had an impact from the forex losses. But what we like about this company is, of course, it has a dominant market share with more than 65%, and of course, it is trying to expand within international through having more wide bodies. It has a very strong balance sheet of more than 10,000 crores of cash, and it is generating cash flows year on year with a strong profitability. Next slide, please. The other two companies that I would be talking about in terms of result updates are Arvind Fashion. Of course, Arvind grew about 11% to about 1420 crores, but the like-for-like growth was stronger at 8.3, despite a muted quarter for most of the retail players. And the EBITDA margin continues to improve year on year. In fact, they are in line with their overall aspiration of growing their EBITDA margins by 100 basis points every year. So what is helping them is their focus on strong core brands that they have, and of course, improving their channel mix towards focus more on the direct channels. So as we see the growth kind of coming in, we will again see here also operational efficiency and operating leverage kind of play out and help them in their margin improvement. All of this will help them in reduce their debt. In fact, they should be debt free over the next 2 years. Uh, and lastly, Karur Vysya Bank, of course, the bank has reported a loan growth of 16%, much higher than the industry credit growth. And it was also reported deposit growth of 15%, which is again much higher than the industry growth. So they have been able to report a strong earnings even in this quarter, where we were expecting the NIMs to kind of come down like we saw for most of the other banks, but they were able to, while they also saw slight marginal drop in the NIM, but they got benefit from one of recovery of one of the large loans that they had already written off. So that kind of helped them in reporting a much better profitability. Going forward, we see the bank to continue to report an ROA of more than 6%, which kind of gives us confidence in their ability to grow much faster and continue to trade at a decent valuations. Next slide, please. Yes. So what has worked for us in this half year has been, of course, Paytm, Karur Vysya, and SBI Life, which I kind of took all of you through the results and how they have been reporting. So apart from the price increase, of course, all of this has been led by the improving fundamentals of these companies, and we are seeing that earning improvement in all of these companies. What has not worked for us in this quarter has been Elevis, TCPL, and ICICI Bank. Of course, few like TCPL, we are seeing some slowdown on the export side because of the US tariff, which should now start picking up from next quarter onwards. For ICICI Bank, there are, of course, rumors that we are seeing some transition at the top level, but kind of brings down the price to an attractive level. That the strong fundamentals of the company continues to remain very strong. Next slide, please. So yeah, so this is the performance of the fund since the launch. As you can see, for this month, we were about 10 basis points higher than the index at 4.4%. On a one-year basis, we have generated 350 basis points alpha with a return of 8.8%. And of course, since its inception, we have generated almost 900 basis points alpha with 29% CAGR return since inception. Next slide, please, Pramod. So yeah, we tend to see that the performance and numbers kind of take all of the limelight, but it is also important to see how this alpha has been generated, and which is why what we have tried to show here is that for us, the fundamental bottom-up stock selection has been the core for Karma Capital, and this kind of reflects that most of the alpha has been through better stock selection and not just having overweight on the sectors that that are the fad. So if for us, what is very important is to uh, uh, look for stocks where we see the growth potential going forward, and which will help us in generating that alpha going forward, and which is why you see this selection number of 5.28 on an alpha of 7.3, which kind of shows that we have been very conscious in the kind of names that we are buying and at what valuations we are buying, and the confidence. So it helps not only in avoid the fad of this, whatever is the fad in the market, but it also gives us confidence and conviction in the stocks that we are buying, despite the market volatility. So bulk, as you can see, we remain firm in our belief that more sustainable alpha can be only created through strong research driven stock selections, and when that is what has helped us in generating this alpha, and we believe that will take us forward as well. I think that is it from my end. I will hand it over to Vinay to take over.
Thank you. Just a reminder that you have any questions, you can type on the Q&A box or the chat box, and we'll take it up from there. We already have questions, but maybe we'll take all the questions after Vinay is done with his couple of slides from us. Thank you, Vinay. You can continue.
Yeah. Thanks, Ekta and Praveen. Good evening, everyone. So I'll be just taking you through the all cap strategy, which includes both on the PMS side, which is in the form of Karma Wealth Builder, and the AIF in the form of the Jasmine AIF. Next slide, please, Pramod. So if you see the current allocation again continues to be heavy towards healthcare. But in the last, I would say 6 months or so, we have trimmed down position in some of the companies like say Cipla or Zydus Life Sciences, where we had slightly higher weights and we have sort of reinvested it into other pharma and other sector companies. So overall, if you see currently in the portfolio, we have around 23 odd names. There is room to add a couple of more names into the portfolio. But in the last, I would say a couple of quarters, what we have added is two names on the IT segment. And these are not your conventional IT names. These are niche IT companies catering to specific sectors in the pharma and insurance space. Other than that, what we have added is on the payment side, one MobiKwik, which has done reasonably well for us since the time we've added it to the portfolio. And we've recently added one bank on the MFI space. So again, that we are gradually scaling up the position. So overall, again, if you see from a portfolio perspective, we continue to expect strong growth coming in at around 22 odd % over the next couple of years with an improving return on equity profile. So for the portfolio, at a portfolio level, you're seeing the companies approaching the 20% mark, which we aspire to. Most of the companies, again, in the portfolio continue to be net cash companies, specifically all the pharma companies which we have. And other than that, also the companies which do have debt over there, also the leverage is very minimal. So at the portfolio level, again, if you see the debt to equity at the net level is at 0.13x. And valuation wise, also portfolio continues to be at reasonable levels at 20 times on a 1 year forward basis. Next slide, please, Pramod. So from a result perspective, if you see of the 23 names which I talked about, I think just a couple of names are yet to report. Give or take around 20 names. Of those 20 names, I would say barring maybe a couple of names, most of the companies have actually delivered either in line or higher than expected growth, both on not just the top line, but as well as on the bottom line. I would be taking you through a few of these companies in the subsequent slides. Jubilant Pharmova, again, it's one of the largest holding, has done quite well for us in the last 1 year and 6 months. We had actually, in fact, increased the position or the weights in the name when the stock had gone at around 900 odd levels. So again, a very robust quarter for the company, 12% growth on top line and a higher growth at the profitability level. So you're seeing a margin improvement coupled with the top line growth coming through for the company. And again, what we are seeing very critical is the company's contract manufacturing line coming on stream at a very opportune time. So in the last 6 months, we have been hearing companies looking for contract manufacturing, fill and finish facilities in the US. And most of these companies want to outsource their work to companies having manufacturing facilities in the US. So the company is actually doubling their contract manufacturing lines, of which the first line has come on stream in the last quarter, for which, again, the entire capacity is filled with orders. You're expecting the second line to come in by FY28. So by the time this existing line reaches peak utilization levels, you'll have the line 4, which will come on stream. Other than that, also, if you see the other business segments like Radio Pharma, there also you're having key launches coming in the next couple of years, and the CRDMO business. So this is a business similar to, I would say, someone like a Syngene, what Syngene does on the drug discovery part. That is also gaining traction, quite a lot of traction. So the company has orders or molecules which are getting into commercial phase for or into execution phase for them. So you'll see an accelerated growth continuing for Jubilant Pharmova. Gujarat Pipavav, again, a very one of the names which delivered a strong set of numbers. So 30% plus top line EBITDA and PAT growth. Here again, the growth is currently being driven by your all three segments, the liquid, dry bulk, and the RoRo, which is exports of cars through shipments. Uh, and again, this outlook continues to be positive on all the three segments. Container volumes have been sort of flattish because of the crisis which is happening in Middle East, and slight impact on account of the US tariffs as well. So this again is expected to come back strongly in the second half of this year, and then continuing it in the next fiscal year. Over here also, if you see, the company is doubling or increasing its liquid capacity. So they are setting up a new jetty, which will take the capacity from current 2 million to 5.2 million metric ton per annum. And again, that also coincides with this Kandla Gorakhpur LPG pipeline, which is coming on stream in the next fiscal. So what would that lead to is a faster evacuation at Pipavav, and which will in turn boost the company's liquid volumes. So again, valuation per se continues to be reasonable with almost a 6-7% dividend yield. So we continue to hold on to that name and be positive on that name. Next slide, please. Alivis Life Science, again, it has been a drag, I would say, on the returns per se. But if you see, the underlying business performance has been very strong. And in the current quarter also, if you see 16% top line growth led by your non-Glenmark Pharma business, which grew at 40% plus, and the CDMO business, which is again very small right now, but that also grew at a healthy 16% plus rate. The company was able to improve its both its gross margin and EBITDA margin, which is reflected in the EBITDA growth and PAT growth of being 30% plus. In the second half, we are expecting the Glenmark Pharma business to come back. And also, we will see further ramp up in the CDMO business. So, with new projects getting into commercial phase. They currently have around four projects which are already commercialized. You'll have one more project which will be joining in, getting into commercial phase in the second half. And going ahead, also every year you should see at least two projects getting into commercial phase as far as the CDMO business is concerned. Over here also, if you see, the company has a strong balance sheet with a net cash position. With the change in the management from Glenmark to Nirma Group now, the company has gone ahead with an aggressive capex plan where they want to double their capacity by FY 28-29. This again will have a high asset turnover, and margin profile also will be better. So again, on a strong footing for a multi-year growth trajectory as far as sort of a mixed performance. If you see overall 6% growth, India business was 8%. But if you would have recalled, there was an issue as far as the import of rare earth magnets was from China, because in the first quarter, towards the later half of first quarter, China had actually stopped supplying rare earth magnets, which in a way impacted the company's performance in the second quarter. Adjusted for that, the company's performance would have been 12% plus. And now towards the heartening thing, Yeah.
Whenever we're
So the
losing you,
other,
I think. Yeah, sorry. Can you
uh,
just
uh,
repeat the last? It's fine
so
now. Go ahead.
yeah, so rare earth magnet, as I said, the situation is normalized now and supplies have resumed from China. On the overseas business, again, the company has won significant orders and which will get into execution phase in FY27. So there also you'll start seeing ramp up in revenues, which will support and turn around that business which is currently loss making. What we like about the management is if you see post the divestment which they did in FY23, there has been a strong financial prudence in terms of strict control on fixed cost, focus on strong free cash flow generation, and significant efforts put in towards debt reduction. So, from a net debt to EBITDA of almost 2x, the company reported had brought it down to less than 0.3x in the current quarter, and which is also reflected in the free cash flow generation and higher profitability getting reflected into better return profile. So from 12% when we had first bought that company in middle of FY23, but the company currently, if you see for the current quarter, has reported an ROC of 24%. So we feel that again this business is on a strong footing and it's getting into newer EV related products. So currently, if you see contribution from EV is already at around in double digits, and it's only expected to grow with the higher adoption of EV in India. The last company which I will talk about is Zydus Life Science. Again, a strong set of numbers, 17% top line growth, and EBITDA and PAT growing in mid teen. Over here, again, the company is confident about driving growth in the US on the strong 505(b)(2) product pipeline, which is again limited competition products which they have, and continue to launch around 30 plus products into the US market. Moreover, again, if you see in the last 6 months, they have acquired two companies in Europe, one a medtech company. And second is into consumer space, so wellness space, which is the full integration impact which you will see in the second half of this fiscal, and full impact will be there in the financial year 27 for that. So again, this business also continues to do well for us. Next slide, please. So again, as I said, like what has done well for us in the last 6 months is Verob, Pharmova, and SBI Life. The laggards clearly has been Heikel and Crompton. Again, first half has been a complete washout for both these companies. We expect the performance to improve in the second half for both Heikel and Crompton. And Alivis, as I said, the price should hopefully start catching up the underlying business which the company has been delivering for the last couple of quarters now. Next slide, please. So in terms of performance, again, if you see on a 6 months basis, we are lower by 50 basis point. Whereas on a 1 year basis, again, we have a bit of catch up that needs to be done. And which is again on the names which I've discussed so far. Basis that if you see in the current month itself on a month to date basis, there is almost a 2% alpha versus the benchmark. So we should hopefully catch up to the benchmark returns and try and deliver and do better than the benchmark in the next couple of months. Next slide, please. On the Jasmine, again, it's a replica of KWB, but just on the AIF portfolio, on the AIF platform. Over here, again, everything remains the same. Most of the holdings, there might be a minor fluctuation in terms of the weightage. But overall, again, as I said, we continue to get money with this being an open-ended AIF, continue to get flows. And we continue to deploy money in a prudent manner. So currently, if you see the cash levels are at around 5 odd percent. And we, as I said, continue to deploy it very prudently. Next slide. Again, the winners and laggards largely the same. Pramod, if you could take to the last slide, please. Yeah. So this is the performance for the AIF. This is for the class A, which has the highest fees, which we have displayed. And this performance is both net of fees, net of expenses, and net of taxes, what is getting reflected over here. So with that, I've come to an end. We would be very happy to take questions now.
Thank you, Rushabh, Vinay, and Ekta, for an update. I think I request participants if they can type their questions in the Q&A or the chat box. We already have a couple of questions, so I will accordingly ask, but in the meanwhile, we'll have few lined up as well. From a philosophical perspective or from a Lotus perspective, whether Rushabh or Ekta can take it up, what are our styles of booking profits if the portfolio is growing? And then how do we reinvest, look at reinvesting it back, or we take time when valuations are lower in either the sectors or the bottom companies? So it's more about our profit booking and reinvesting
Yeah,
style primarily.
let Ekta take it. Ekta, you can take the question, please.
Yeah, sure. So generally, we tend to sell out a company when we feel that the valuations have reached a point where we feel that the earnings potential is not kind of justifying the valuations that the company is trading at, or we find a better opportunity where we see the returns are much better. And hence, we would kind of at that point in time sell out from an existing position and then buy a new one. But generally, we tend to avoid selling stocks and then again buying back, because that would not only increase churn but also it will kind of create operational kind of expenses for you and higher taxes as well. And if we believe that the fundamentals of the companies continue to remain strong, then we don't see any reason why we would want to sell at a price and then try to buy it back at a lower price.
Thank you. And I think that's why we are generally our churn ratios are 30% or lower in most of our portfolios as well. Just one second. Okay.
Yeah, I think
As Lotus, sorry, Rushabh, go ahead, please.
I wanted to jump in here. Sometimes people get worried that our low churn is not that great a thing. I would say we are not we don't get married to stocks. Yes, sometimes we do maybe hold on to them slightly longer than we should, but we have a healthy churn to the portfolio. So as Ekta mentioned, where we think that the prices no longer support the earnings or cash flows, and they've run much further ahead, we would definitely cut and put that money to work at some other for some other business, or where we have gone wrong and where we think that the thesis is not playing out as we would have anticipated. In both cases, we would be quick to kind of reallocate capital to better ideas. So from our perspective, low churn doesn't mean that we get wedded to ideas. It just means that we are far more high conviction guys, where most of the companies we buy make money for us, and our hit rate is reasonably high. So I think I just wanted to kind of jump in and add on that. Please, Praveen, go ahead.
That's what covered. And another couple of questions in the chat box, maybe I'll take it up answering quick one for the larger audience. GICS, which Ekta mentioned in an attribution slide, stands for Global Standards of Classification for Industries. So that's how sector classification has been defined by MSCI. So we use that for attribution purposes. Specific question for Vinay. Are you looking at some of the companies in your portfolio? How do you look at exiting some of the position or rebalancing it in next 3 to 6 months? Is there anything specific in your mind for KWB or Jasmine for that matter?
So in the last 6 months, if you see, we have exited, I would say, both the media names, which were again giving us quite a lot of pain. And again, as I said, like we've added on to 4 new names into the portfolio. It is a very iterative and continuous exercise which you keep doing, where we feel if the company is not making business case, we would look to exit. Right now, again, we are in a wait and watch mode for say a couple of names where I would be very closely monitoring the performance. So especially again, Heikel and Crompton being the 2 names. But the good part is the overall allocation towards these 2 names is not that significant. So yeah, that's about it.
Thank you. I think there's a question on sector allocation on Lotus portfolio. I think there's some miscap, which I understand the large cap allocation is around 22 to 23%. and small cap is around 44%.
Yeah, I think the color grading might be a
Yeah,
confusion maybe.
we're just clarifying that the in the portfolio there are 23% large cap, 24% mid cap, and 44% small cap, and approximately around 8% of cash at this point in time. Just clarifying that part. And one more question for Vinay specifically. I'm just reading that out for you. Is there any sectoral preference for KWB by mandate, and what is your broad thesis on healthcare? If Vinay can take it up.
No sectoral, again, like as we keep telling, we are sector and benchmark agnostic. We go where the best ideas are. As I said in my opening remarks as well, that we have tried and trimmed our position on healthcare, which at one point in time had almost reached around 33 odd percent. The reason why currently it's looking at around 28, 29% is because of the two IT names which I mentioned. Because they are, at least one of them I know of, is related to pharma or it is catering to pharma. It is clubbed under healthcare, but information technology. So it's just the classification wise, which because of which you're seeing healthcare being at around 28.5%. But we have consciously almost trimmed close to 8% weight in the last, I would say, 1 year or so across companies where we felt that where we again did a bit of trading, I would say, because Pharmova also we trimmed some position at around 1250 odd levels when it had gone a couple of months back, and then when it came back to around 900 levels, we added it back. So and which again worked in our favor. So no such sectorial bias as such. Open to all sectors. Healthcare, again, why we continue to like is a couple of, I would say, 2, 3 points, because most of the companies which we cater to are present in India, have a strong presence in India. It's a highly profitable business, high free cash flow generating business here in India. And when it comes to the US market also, these companies are into not into plain vanilla generic products. They are into complex generic products. Cipla, if you see, it's into inhalers. Zydus, if you see right now, it's getting into specialty products, which say Sun did, I would say, a decade back. So a single product could be almost like a $500 million opportunity for Zydus in the coming, I would say, couple of years. So a very differentiated approach when it comes to the US market as well. Uh, yeah. So again, broadly these reasons, and again we continue to see growth coming through for these companies, and that's the reason why we are continuing to hold on to this set of names.
Thank you, Vinay. I think being Ekta being our banking expert and also having some small banks, any specific view on small banks as a segment, Ekta? And you obviously covered one of them in your slides as well. You're on mute, sorry. Ekta, you're on mute.
Yeah, sorry. So yeah, so like you said, we have one private regional bank, which is Karur Vysya Bank. But apart from that, what we are actually looking is more on the alternate space or more on the fintech side, where we see the growth opportunities to be much stronger. We are seeing now specifically on the, I'm guessing the question is on the small finance banks. So for us, what we believe is that microfinance as a sector, most of these small finance banks have large proportion of microfinance within their book. And as a sector, we have seen a lot of volatility within that sector. And we believe that most of them have the aspiration now to move towards a universal bank eventually, like we saw for AU. For now, we believe that we would, from a Lotus perspective, we would stick to KVB, and of course, we keep evaluating these small finance banks if we find anything interesting going forward.
You being there, may we ask another question on Lotus?
Sure.
Generally, as we did mention that the churn ratios are 30% or less. Somebody just asked that churn ratio will stay the same compared to, as a house philosophy, we churn less. But in small and mid, especially Lotus, our churn ratios will also be around the same levels? Or is that being different for last 1 year perspective?
Honestly, churn number is eventually an outcome for us. What we look for is whether that stock fits into our philosophy and whether the valuations and the earning momentum going forward is comfortable for us to remain within that stock. So eventually, it is an outcome for us. What we keep doing is keep looking for newer ideas and keep evaluating our existing stocks within our portfolio and see whether it makes sense to switch from one stock to another, or we think that this so for us, we don't look at it as a number that we have to track or we have to reach certain number. For us, it is more specific, portfolio and company specific. So there are few companies within the portfolio where we have trimmed down quite a bit of it and then switched to another company within that sector. So more recently, we have trimmed down quite a bit of e-clerks and then we bought a lot of sagility within our portfolio. So we have seen some amount of churn increasing, but as we see, if we feel that the valuations, we will keep booking profits.
Thanks, Ekta. Vinay, we have some allocation of auto in our all cap strategies. Any
Yeah.
specific views broadly on auto? And you did mention that there's some tech companies which are classified as healthcare. So anything specific on medtech on your mind which you can share your views on?
Yeah. So again, with the GST rate cuts coming through, we're definitely seeing bump up in secondary sales coming through for the last couple of months. And this again, we feel that it's expected to continue at least for the next couple of quarters. What we're trying to do is maybe because some of the OEMs are very richly valued, we are trying to play that theme via the couple of auto ancillary names which we own. So Varroc Engineering is one which we own, and Sansera Engineering is the other one. Both of them, if you see, have a higher presence on the two-wheeler and three-wheeler side. But at the same time, Varroc is trying to increase its exposure from the four-wheeler. So in a way, it's a quasi play on the demand revival which we are seeing coming through. And what happens is, Varroc, I talked about, they getting into EV related components, which is again, as I said, almost EV OEMs contributing 11% plus to the revenues. Someone like a Sansera who is into aluminum forging and lightweighting. So again, the trend of EV where you need lightweighting or reduce the weight of the vehicle. That is where again these two companies are playing it out. More so from Sansera's point of view, if you see, they are focusing more on the non-ICE sort of a portfolio and the non-auto portfolio. So the aerospace, defense, and semiconductor, that continues to be a very big opportunity for them. The company has guided for a strong. So currently, if you see, they already are sitting on almost upwards of 3,000 crores of order book in this space only. And the current revenues, if you see, it's only 86 crores for the first half of this fiscal from the aerospace, defense, and semiconductor. So this again will be a key driver for Sansera in the coming quarters and years. And again, well positioned, I would say, to capture both opportunities on the auto and the non-auto side. And within auto also, irrespective of whether it is ICE or EV, these companies tend to benefit because they are basically engine agnostic in nature. On medtech, again, it's a very organic extension for these pharma companies because they have a good presence, good network. Uh, you have seen both the companies. So Zydus has done an acquisition for a France-based company, Amplitude. So they again want to expand the presence globally for those their set of products. And you've seen Alchem also getting into medtech.
I think we lost him. In the meanwhile, Ekta, can you take up a question specifically
Yeah,
on?
no, let me just finish the medtech thing. So, from our perspective, this is very large opportunity in India going forward because we think that as the per capita income rises in India and as insurance becomes more and more prevalent and widely distributed, the opportunity for medtech companies will become very large. So we are at that cusp or beginning of a very large opportunity in medtech. Which companies, how much they will benefit, we'll have to wait and see, but it will be a very large opportunity over the next decade or so. Go ahead, Praveen.
Yeah, thank you, Rishabh. Ekta, a specific question to you on aviation going forward. Any tough competition seen for Indigo from Air India or any regulatory challenges for the sector at large? So, Ekta or
Yeah.
Rishabh, you both have strong views on that. So, any one of you can pick it up.
So, Indigo, of course, we are seeing the demand remaining very strong, and Indigo, of course, has the largest order book. We feel that right now the industry problem is not the demand but the supply, and the supply for even Air India has been slower than expected by even them. And Indigo, of course, has been very strong in terms of its order book and increasing its capacity. It is also very smartly increasing now capacity and adding more destinations at the international side, which will help them in grow faster and more profitably. There are a few regulatory changes that we have seen in this quarter, or at least we have heard about it. And Indigo has kind of been upfront about it, saying that it could have some impact on their overall cost structures. But we believe that they have reached a point where the pricing power will kind of start to play out, and the impact on the profitability will not be as much. Uh, Rishabh
No,
says.
I just joke about it. Where is the competition? I mean, you have a 60% market share. No country large like India has such a huge concentration. That's because there is no competition. My sense is that Indigo is one of the very large businesses where there is very little competition. And I don't think so there is a line of sight to competition over the next 2 to 3 years at least.
I think there's one last question on the pipeline. Any views on EV or energy specific? I thought I'll ask Vinay to cover with auto, but I think we just lost him in the internet.
Yeah, sorry, apologies, I got disconnected. Uh, Sorry, you were asking something,
We did cover
Praveen.
medtech. Rishabh covered the medtech part, continued it. Any views
Okay.
because you talked about auto? Any specifically on EV sector? You did have some indirect play which you mentioned in your answer towards auto.
EV again, if you see on the two-wheeler front, if you see Bajaj continues to be gaining ground on the two-wheeler front, and again Bajaj is like an anchor customer to Varroc. So and again penetration level, if you see from an EV perspective, we are at around 7-8% for two-wheelers and roughly around 5% for passenger vehicle, which is only expected to increase as we move forward. So again, on the two-wheeler side, we are trying to play it through the auto ancillary names which we have. And on the passenger vehicle, again, if you see Tata Motors is the market leader. They have had a very strong launch in the form of the Harrier EV, and they are gaining back the lost ground which they had in the last 1 year. So both these companies, again, the auto and companies and Tata Motors continue to be on the strong footing for us.
Thank you, Vinay. I don't see any further questions from any participants here. Uh, and it's perfectly on time, I guess. But Rishabh, any closing remarks? Because you did mention in your initial thoughts that portfolios should be thinking differently for the next cycle and we should position it
I
not with
think,
and look
yeah,
at.
absolutely. I think let me just correlate that to our stocks. So I think companies like Sagility, Indigen, etc., are starting to use AI very extensively in their processes and as an offering to their customers. Even a company like Tata.com will benefit significantly from what we are seeing in the investments in the AI stroke data center space. And similarly in payments, which Ekta mentioned, I think payments is increasingly becoming AI driven in many ways and data science heavy because you kind of are doing a lot of data mining in terms of your customers. So if you look at our portfolio, we are starting to, or companies are there which are starting to use the technology. Either they are users of AI or they are beneficiaries of AI like data centers where Bharti and Tatacom both have a very large play on the data center business. I mean, people talk about data center businesses and companies which will benefit. People don't even talk about Bharti and Tatacom. And to us, those are the two largest plays on data centers in AI. So our view is that a lot of our companies are starting. So it's not just new AI based companies, but even some of the conventional companies which are going to start using AI significantly, which will drive maybe a significant productivity improvement or a competitive advantage over times to come. So I think we are becoming more and more cognizant of that when we build our portfolios, and hopefully that should start reflecting as we go forward in both in terms of our performance as well as in terms of the names we own.
Thanks, Shiva. There's one last question which is more related to performance, but I'll take it up. The question specific said how much alpha can be expecting next 2 to 3 years from both all cap as well as our Lotus strategy. Simply, if I put numbers in perspective, what we have delivered over last 3 and 5 years should be the right benchmark to see what we can do in next 3 to 5 years as well. As I see, we have been able to do a 400 to 500 basis point alpha over 3 and 5 year period for all cap. For a longer period, obviously, it is a little more longer. And same as for Lotus, we have been able to do between 500 to 800 basis points. And we are confident, given that portfolio performance in terms of earnings has been in place, we should be able to reach that at least for next 3 years period as well. Any if you guys differ and want to add, whenever, please feel free to add to that part. Although there's always a disclaimer, past performance is not an indicator of future. I think we are confident that given the market cycle, we should be able to reach that as well.
I would just like to end it with saying that, look, at the end of the day, performance is very important. Alpha is very important. But I would also urge you to look at the quality of alpha that we are generating. Our alpha is coming from very good quality businesses, owning them for longer periods of time with a low churn, high conviction portfolio. So alpha is very important, and we are very focused on the alpha, but we are also focused on the risk we take while generating that alpha. And it's very important to keep talking about risk, not just returns, because at the end of the day, that's what is important from a manager standpoint. That what is the per unit of risk we are taking to generate that returns, and what is the underlying quality of businesses from where we are generating the returns is equally important. So sorry, Praveen, to just jump in, but I want to kind of reiterate this point once more.
And
Thanks.
that's very evident from the slides we presented that we have, even by being that alpha, we have a lot of large companies in our portfolios which have done really, really well. As examples, we have taken whether it is SBI Life or Simplas or auto companies, etc., etc. I think the key part for us has been to able to deliver higher returns even with large cap companies, which is not the trend in the market. People expect multi-bagger companies like Bharti or Indigo, which have been our portfolio for 5 years and 3 years respectively, has been in terms of returns in terms of X and not in terms of basis points. So that's clearly shows that we take lesser risk for generating alpha, not trying to get into the down or the micro caps and small caps, and trying to even do that by being right, identifying earlier than others, and trying to be not following the narratives largely. I don't see any other questions in the chat box. I'll just revisit it once. But so I think there's no other questions, so we can wrap up. Thank you everyone for being here
Thanks.
and spending last hour with us, large audience. If you have anything, you can reach out to any of our colleagues for any further questions. Thank
Thanks,
you,
everybody.
Kavin and Rishabh, for the
Thank you.
session.
Thanks. Have a good evening.
Have a good evening, everyone.